Tonight's grid is on the BRRRR strategy, which is my favorite. This is what I've used to invest in real estate for like 6 or 7 years now. And it's the one I like to talk about the most because it's the one I practice the most. And I honestly think it's the best way to invest in real estate. Um, if someone were to ask me if you're starting as fresh as a brand new investor, like the steps I would have gone now that I know what I know, what steps I would have taken. My first step would have been to buy a 4 unit building using an FHA loan and live in one of the units. And then second step would be after being there for a year or two, buy a 2 unit building using a 5% conventional, and then go buy my primary residence, and then start doing the BRRRR method with the extra money I have for my apartments. I even sprinkle in a flip in there just to like get your experience up. But I think that's the best base to build an investment portfolio if you're not starting off with a ton of cash, right? If you're starting off with a lot of cash and you don't want to do the work, you're better off just investing in some sort of a REIT or something like that, right? But if you're someone that's looking to build it from the ground up without a ton of capital, that's how I would go about it. And I like the BRRRR method because, as you'll see, it allows you to reuse your funds quite often. So, all right. So just to touch on this again, you guys know, and you'll learn great as a global real estate community built for investors by investors, not gurus, just a bunch of real estate people doing real estate deals. So in order to qualify to be a grid chapter leader, I just had to be an investor with a certain amount of deals that I've done. And also, I'm a real estate agent and do a lot of transactions. So I have the history for it. Um, our mission is to connect, learn from, and collaborate with like-minded people interested in building wealth and creating impact through real estate. And we welcome investors of all experience levels. So in October, I had an investor here that has 700 units. I have people that haven't done any. That's fine. There's people in between that have done, a handful. Totally fine. Like we're here to learn, and kind of soak up from each other. So who am I? My name is William Holder. I run the William Holder Realty Team as well as Remax Classic in Wayne. Um, I run this group because I love investing in real estate. I got into real estate to be an investor and then realized I needed money to invest in real estate. So I started selling real estate and then fell in love with that. So now I do both. And I this is still though my passion when it comes to real estate. I love talking about investing. And when I was able to, when I had the track record and I felt comfortable enough to actually run something like this, I decided to start up uh, an educational seminar like this for real estate investors. Um, what I'd like to accomplish with you, one, give you as much free information as possible, right? Like that's where I got all my information was free. Podcasts, YouTube, uh, paid for some ebooks, like, things like that. I didn't ever go to some of these $20,000 seminars that they just teach you when you could have just used the $20,000 to buy a property, like I don't think anyone needs to do any of that. I think there's so much information out there for free that you can become a master real estate investor without ever taking a paid for class. Um, to accomplish with you, I mean, it's already kind of happening. One of my first grid people that came to one of my first events were working to buy a building in Pittsburgh together, and I've helped them do a lot of transactions. But a couple other people come through that I've helped do transactions and eventually hopefully will partner with. So that's essentially my thing. And you can connect with me through Instagram, William Holder Realty Team, Facebook, William Holder Realty Team, Will at WilliamHolderRealty.com, my website, WilliamHolderRealty.com, or my cell phone number, 610-657-6215. And I'll give you guys all this information if you ever want to connect. So as we normally do, we'll go around the room, just give everyone a quick information as to who you are. Are you currently an investor? What types of properties are you interested in? What you're hoping to learn, and how, obviously your name as well, and how do you hope to benefit from the group? Keep it quick and simple. So start over here.
Casey Ross. on that want to learn more.
Okay. Awesome. Awesome. Alrighty. Uh, Important legal stuff. I'm sharing free information. Don't sue me. All right. I do record this for our YouTube page, so if don't say anything on here that you don't want to be recorded. Uh, okay. So, um, what is a buy and hold, right? Whether you uncover opportunities through prospecting, networking, or marketing, getting the phone to ring is a critical skill to become a successful real estate investor. Uh, Real estate investors find their best deals off market, right? It's no secret. Um, I'm an agent. I tell my clients that. I'm like, look, the stuff you're going to find on the MLS, you're fighting against other homeowners, right? Like before COVID, people wouldn't deal with fixer uppers. Like my average home buyer wouldn't even want to see a foreclosure or a fixer upper. Now they don't have a choice because there's not a lot of options. So as an investor, you're fighting against people that don't need meat on the bone, right? So just are there good deals on the MLS? Sure. Your best deals you're going to find off market. A buy and hold refers to a property you purchase with the intent of owning for a long period of time versus a flip or rehab, which investors typically hold for 6 to 12 months or less, otherwise known as income property or rental property. Big difference here is I have a lot of investors that get started and ask me like they're tell me they're thinking about doing a 1031 exchange with a flip. And I'm like, well, you can't do that, right? Like, and people think that's the game is the government wants you to hold these properties. They want to see that you're leveling up. So that's why they give you the option for the 1031. It's a flip, it's quick income. They want to tax you on it, right? That's a great question. And that's a deep, deep question because there's a bunch of ways, right? Number one, wholesalers, right? So connect with a bunch of wholesalers. Um, it's kind of a bittersweet thing with wholesalers and real estate agents because we're very opposite in our what we're doing, right? Like as a real estate agent, my job is to sell your property for the most money possible. As a wholesaler, their job is to get your property for the least money possible, right? So I don't allow my realtors to wholesale under their real estate license. It's just I think it's contradictory, but there's plenty of them out there that do it. But a wholesaler is out there looking for deals, right? They're doing the nitty gritty. Now you could do what they're doing, which is get lists, right? Pre-probate, uh, tax liens. You could go on sites like PropStream or Skip Trace sites, find these lists, skip trace the numbers, and start calling. Or you can get even more creative and have a virtual assistant call them, right? And pay them $5 an hour to make calls, right? And there's other types of lists you can collect as well, but that's generally what wholesalers are doing. And when they go to the seller and they say, hey, your property is worth this when it's really worth this. And then they go sell the contract and make the middle. You as an investor, if you could get it here, you make that earnings, right? So that's one way. Signs, you see those "we'll buy your house cash" signs. That's usually wholesalers, but it could be an actual investor that actually wants to buy the house cash, right? Um, uh, Driving around. I mean, if you see a rundown property in your neighborhood, it's not that hard to get that person's information, and call them, right? Hmm. Hmm. As long as they're staying within the standards of the township, like keeping the grass to whatever length and the things like that, and the township isn't constantly fining them or violating or putting violations on them, they can keep the property. So if it, yeah.
You wanted the Act 35.
Oh, is that like next door lot or whatever?
Yes, I just wanted that.
Hmm. Yeah. Yeah, I think with one like that, it's like if well, it's not share sale because it's they're doing it before that, right? Because the person's probably paying the taxes. Yeah, like they're probably doing it based on condition and safety. Like if you if the property is deemed unsafe and like a treachery to the neighborhood, especially with row homes, that's easier to say than a single family freestanding home. That there's things like that. Also in Philly, there's like if the property is adjacent to yours and you're the owner of that property, there's an act you could buy it for $1 as well, but you have to prove that you live next to it. There's all these things in Philly they try to do. Some of them good to keep properties within the community, and some of a lot of the times that doesn't work out because the amount of loop, the amount of like red tape you have to go through, it just ends up not being worth it, and corporations just end up buying them anyway. Um, so we talked about off market wholesalers, driving for dollars. Uh, I mean, get a good real estate agent that's familiar with investing to set up a search and constantly send you stuff. They might find things off market. If you're looking in a specific neighborhood, find out who the agent is that sells all the properties in that neighborhood, right? There's usually a predominant agent in the neighborhood that's doing 10 to 30% of the business in that neighborhood. And if they are, that means they're connected with a lot of people in the communities. And when a good deal comes up, they might call you first because you're willing to work within the community and work with them. So you can find agents specific to a neighborhood. Um, I mean, you can run ads on Facebook, talk to people, like let them know you're looking for deals. Go to meetups and talk to other investors that might have deals, right? Like a lot of those meetups is guys looking for to sell a deal, and just being there puts you in that position. Um, there's a bunch more, but that's just a good starting point. I mean, my most successful deals were buying lists and having a VA call them. But pick an area that's not oversaturated, right? So like if you have Philly lists, I mean, how many people are calling? Thousands, right? Like they're probably getting a bunch of calls from everyone. Whereas like you go out to kind of a rural area, doesn't have to be in Pennsylvania, and you get a list of numbers, chances of them getting as many calls as someone in Philadelphia or Delaware County is significantly lower. So they might actually take the call more seriously. So when I moved out to like Carbon County a few years ago, I was getting tons of answers, right? And I did like 11 deals that way because nobody else is calling these people, But then 2 years ago, that stopped and everyone was calling them, right? So you got to find the market. But yeah, I think the off market route, getting lists, having a VA call, unless you want to do the calling. But if you have a full-time job, chances are you don't have time for that. So you're better off just paying someone. And there's great virtual assistants that'll dial hard for you. So you have a question or um I'll give you the number of a guy who I got two of my VAs from. I like it because they set me up with someone and they hand them off to me. So a lot of the platforms that are charging 12, 13, $15 an hour, they're actually taking most of that. The person that's doing the call is making $4 to $6 an hour. So yeah. So those VA platforms, they're taking the majority of the money. So you're better off just getting one that's dedicated to you from like a flat fee type of setup. I think I paid like $1,000, but I've used that person for 6 years. So like, I've made that money well back, well over, and they came trained and, you know, perfect English, like knows how to use the calling systems, better salespeople than half the people on my team. No, no offense, guys, don't listen to this. Uh, and that's I tell her, I'm like, if you ever plan on moving to the States, please call me. Like she'd be great. Mhm. I mean, you could get them to do all that for you. Like whatever you train them to do, they'll do. So, but personally, I get the list, and which takes no time. And since I'm using my card and stuff to pay for it, I'm not trying to hand that off. So I get the list. When I'm not doing as much calling right now. I'm using it for other things, but when I was calling, I'd pull a monthly list and send it to her. Um, yeah. All right. So the considerations for buy and hold properties are different than those from a fix and flip. But several issues are the same. How much free cash do you have to market for, buy, renovate, hold, and rent the property, right? What is your long-term strategy for real estate investing? Is it income? Is it cash flow? Or is it both? What's your risk for tolerance? What is your tolerance for dealing with rehabs, contractors, tenants, buyers, and agents? I ask everyone that comes to me that wants to be an investor these questions. I'm like, have you even started an LLC yet? Have you read anything about real estate investing? Do you have at least 40 grand in the bank? Like for me, if you don't have these things, you're not ready to go. Like it's just too many people think you can just have a couple of $1,000 or even $10,000 and go invest in real estate, and your ship's gonna sink really, really fast. So I think being honest with people or being honest with yourself, save up more before you get going, read some books, and figure out what route you really want to go. Because most people don't realize you're only making, if you're doing a BRRRR, $100 to $200 a month per door after all expenses. It takes a long time. People see these viral videos. There's one everyone was sharing with me this week. There was a girl at like a Grant Cardone seminar thing, and she was saying she's making $10,000 to $15,000 a month in rental income off of one property. And like I've got that video shared with me like 8 times this in the last week, and I'm like, guys, if it was this easy, we'd all be retired. Like she's renting to insurance companies for people that need short. Yeah, so from what I've learned so far about it, is that her primary game is she keeps these properties as like Airbnbs. And when an insurance company needs somewhere to put someone, like their house burned down and has to be rebuilt or a tree hit it, insurance companies will pay a premium for you to have someone live there short term. Again, that's short term. It might be a 3 month thing, it might be a 6 month thing, and then you might not have a tenant for a while, right? So what they're not explaining is that income is condensed versus spread out, right? Yeah, 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 yeah. And the other thing is insurance companies are all cracking down, right? Like they're doubling everyone's rates. I mean, one of my friends is an insurance adjuster, and he's like, man, they're beating me over the head with things I'm allowed to approve anymore. So insurance companies are cracking down. They're going to look at all their numbers, right? So if they start looking at what they're paying out for rentals and they realize someone's given out a bit too much, I don't think it'll last forever. So I see stuff like that, and I just have to remind people, like when it sounds too good to be true, it is, right? Like real estate's not a short game. All right, so where do you want to own and hold rental properties? How long do you intend on keeping a rental investment? How will you manage your first few properties? How about 10 plus? And what rate of return do you get from other investments? This is big, and we'll talk about this. What rate of appreciation do you expect from real estate? So where do you own and hold rental properties? When I started, I was cool. I was like, I should get a bunch of stuff in Philadelphia, right? Because it's cheaper. And now I've sold 13 of the 15 properties I owned in Philly, and I'm trying to sell the other two as soon as I can get the squatter out. Uh, it, I don't have the belly for Philly. It's just not for me. The rules there make no sense. I've spent too much time in eviction court. It's not to me a fun, not that real estate investing is fun, but it's not an easy thing like to deal with. You know, it's not realistic. I just hate the tenant landlord laws in Philly. I don't want to deal with it. I can invest other places. I learned that the hard way. Not that I didn't make money. I made money when I sold all these properties, but I paid taxes on that I didn't want to pay. So uh, understand where you're investing. People call me and they say they want to invest in Philly. I explain to them, do you understand the Philadelphia rental laws? Make sure you do before you get into this, right? Um, uh, and also that's not, I mean, the tenant class thing is not just a Philly thing too. Like I own stuff in Carbon County, heavily blue collar, right? There's problems you wouldn't normally deal with that you deal with in areas like those, uh, bed bugs, kid issues, like you deal with a lot of stuff. So understand what you're willing to deal with. If you don't want a lot of those problems and you go in the higher end, there's problems there too, but they're just a bit more it's more financial usually than emotional or things like that. Uh, how long do you intend to keep the rental? And your long goal? Is your long goal to stack these, sell them, buy bigger things, or is your long goal to just keep building the prop with single family versus going multifamily? Are you playing Monopoly, or are you just cool with stacking a few single families? How will you manage your first few? This was a mistake I made where I thought because I was in real estate, I could manage my own properties, and when I realized I got to a certain number, I was like, Jesus Christ, I don't have time for this. Then I had to hire someone because I didn't have a property manager. I should have just gotten a property manager for the properties. I hired someone. It's fine. It worked out because in the long run, I ended up getting more doors and it pays for itself now. But whatever you're doing, make sure you account for a property manager eventually. What rate of return can you get from other investments? So this one's big because I have a client that owns some nice buildings in Ardmore, multifamily buildings. They do really well. They're just investments for them. And uh, he wanted to sell one recently, which we did. And I asked him, I'm like, are you thinking about slowing down? He's like, no, it's just, what I make monthly here, I could clear the same amount just getting 5% on this in, like a safer investment. And I was like, yeah, you're not wrong. And at his point in life, he didn't need it, right? Right. It was like, I don't want to deal with the tenants. I have enough money. I'd rather just take this equity, put it in like a high yield account and take my money that way. I was like, all right, makes a ton of sense. And if you don't have if I mean that's $700,000. Like 5% looks pretty nice when you don't have to do anything for it, right? So um that's the mindset of rate of return, right? If someone came to me and they're like, I have a sizable chunk, well, what else can you get with that money that's easier than real estate, right? If the answer is that, think about it for a second, right? Um, and then the rate of appreciation you expect. We've gotten really lucky. The last 5 years, it was 20% increase, 10% increase, 6%, 5%, 3%. It's been quite an appreciation over the last 5 years. That's done. Like we're gonna get your average rate of return going forward for a while. And hopefully there's not much of a dip, right? But it will come. So understand that. So renovating buy and hold properties, right? Generally, we prefer lower middle market properties and neighborhoods. Again, higher end, the problem with higher end properties, yes, the rents are pretty high, but usually they don't account for all of the upkeep that property needs over time. If you have a 3,000 square foot house, that roof's going to be 25 grand, 30 grand, maybe even more at some point. You probably need two furnaces, right? You probably your overall holding costs on that property over time doesn't necessarily outweigh the profit you're going to make on it. So if you're buying bigger properties, more expensive properties in more expensive areas, make sure you're getting either a super good deal or you factor over time what your capital expenditures on that property is going to be. Generally, when you go with lower middle market properties, you're getting properties at, I mean, around here in that 250 to 350 range that even with the interest rates where they are, they kind of make sense right now. And you're hoping as the rates go down and insurance rates go down, it'll make even more sense. You don't want to be on the super low end because if you're on the super low end, you deal with a lot of headaches. Sure.
What do I get from observed that like when it comes to like
Yeah,
is that a
it could be. I mean, it depends on the area too. Like if it's an area you think that's going to see rapid redevelopment, then go lower end. Like that's kind of my play in Pittsburgh right now. I'm like looking at the sub-markets of Pittsburgh and saying, well, if all these companies are moving there, maybe in 10 years, he's probably gonna be worth a lot more than I paid for him in terms of like return. It the cash flow is nice for sure. And if it doesn't happen, at least I had the cash flow to say I made something, right? Um, the the other thing is I'm not managing them, right? So like I see the report and I talk to my manager once a month and we go over the evictions and stuff and all the problems, but I don't have to deal with it. I know the numbers work, so I'm willing to play that game without the headaches, right? Uh you can do that here if you're willing to deal with the headaches. Um but yeah, your cash flow is going to be better. I mean, some of the buildings I'm getting out there are like 14 caps, like they're great. Do I want to ever deal with it? No, like it's a lot of problems. Like you have to install security cameras and like crazy stuff, like it's so take the good with the bad. But, and I'll get into that property as an example for a burn a little bit, one of those. Again, very low end properties attract troublesome tenants and often require more maintenance. High end properties are nearly impossible to find the prices that support the rents. That's another thing, especially around here. High end properties, what are the property taxes on them? Like $20,000 a year. After you factor property taxes and insurance, even if you owned it cash, how much money are you actually making? Right. So those things to factor. The huge thing to realize, and this is a mistake I made early, was I wanted everything to be perfect. And you can't, especially with the prices of things these days, you can't gut everything, right? You have to find ways to get creative. Don't gut the bathroom, reglaze it, put a new vanity in, right? Don't completely rip out the kitchen, paint the cabinets, put new countertops in. Um, refinish the floors where available, but laminate. Don't go crazy, right? It's a rental property. You're not living there. Yeah, you want it to be safe. You want the main systems to be in great shape. So I want the furnace and AC in great shape. I want to know the roof is fine, and I want to make sure my windows are okay, right? Obviously, structure is always super important, but I probably wasn't going to buy it if it was a structural replay anyway for a BRRRR. So if those things are good, I know I'm going to be 10 years without having to replace at least one of those. I can recoup the funds in my capital expenditure account to get to that point. It'll give me that time. Uh, do they always go perfectly? No. Like Saturday, I have a row home in Collingdale that I bought a year and a half ago, and I bought it was off market. The lady, her like son was a past client of mine, and I said, "Hey, you can get 120 if I list it. I can give you 90 for it." And she's like, "I'll take the 90. I have tax issues. I just want out. I don't want any showings." All right. I bought it. I put 30 into it, and it appraised for 180. Great. Sounds like an awesome deal. I put a tenant in. Had my first rental inspection for the borough for Collingdale in January. They were there for what 13 months at that point, and the place is an absolute mess. Like the floors are jacked up, the whole place smells like pee. I'm like, what has been happening here? So I said, I can't keep you guys. You have to leave, right? So they finally left last week. I was able to get in there Saturday. I mean, all my flooring has to be redone. The paint has to be redone. The reglazing in the bathroom's damaged. My appliances are damaged. They left a bunch of junk. And as I'm walking through it, I'm noticing it's infested with roaches. And I was like, so I had to run out of there. So, that it's going to be like a $7,500 to get that back up and running thing. I made maybe $1,400 the entire time they were there, right? And factor their security deposit. I'm still in the like losing $3,500 on the renovation. So it's not always great. You can buy them as good as you want if you mess up on the tenant, which I really didn't think I did, but it's not always perfect. All right, so the only exception is if the place needs full renovation anyway, then use nicer materials like granite, stainless steel, as the price difference for the materials is low enough to pay for itself in higher rents, right? We know the things that look good that don't cost a ton, right? Like granite, people think costs a ton. It really doesn't, right? And it's way sturdier and will last you longer than Formica, right? Stainless steel appliances aren't that expensive anymore. I mean, pending tariffs or whatever. Like, I think they're not the worst, right? Uh, Laminate flooring looks great, lasts a while, not that expensive. They call it all luxury vinyl flooring, even though some of it's like 80 cents, like, you call it whatever you want, right? So we know the things that look nice. I mean, bright paint always freshens up any room. Um, and we know that you can get a good return because people are going to come in, they're going to feel like this is a higher end property, even though the finishes actually weren't that expensive. And you might be able to get 150, $200 more per month than you would have gotten if you just went with the average. Property managers, third-party property managers will cost you 8 to 10% of gross rents plus half to 1 month's rent at turnover. When I am evaluating a property, I use 18% for property management because if you factor a turnover every year, that's 1 month's rent over 12 months, it ends up averaging to about 18% of your annual rents. So I just factor for it up front. I'm assuming I'm not getting 12 months rent that year. I'm assuming I'm getting 11. And it's in the property manager's best interest to get that unit turned over versus holding a tenant long term. So, even if they're a great property manager, they understand how the numbers work. So I use 18%. I think it's just a better number. It's more realistic. Um, but a good PM can make or break your property. I mean, if you have a really good property manager, they will, even if they're turning it over often, they're keeping people in there, they're keeping trouble away from the property, they're telling you when things are wrong. That alone is worth it, right? Um, as an agent, could I do all of this stuff? Sure. Like, but if you're already paying them, just let them do it all. And there are some property managers that will like guarantee if they put a bad tenant in, they'll re-rent it for free. There's companies that give good deals like that, but just make sure your property manager is willing to work the way you are. Yeah. Yeah, there's like a plus and minus to that. The plus is if you get a really, or the minus is if you get a really shitty tenant, you're kind of stuck with them, and they're like a slow payer and all these things. And also like with these people, I did a longer lease. I did a 2 year lease, and I was hoping they didn't hold me on it, because they luckily left without a fight because they knew how bad the property was, but they could have stayed, you know. So there's a negative to that. The positive, obviously, is that you don't get the turnover mid-year. Um, Another negative could be that the person will sign a 2 year lease, but they don't want a rent bump up. So they're signing a longer lease to get the rents to stay the same. And it's in your better interest, your best interest for the rents to go up each year. So that does kind of suck a little bit. Um, I think other possible negatives, one thing I like to do is try to make my leases end when it makes sense. So I have a bunch of stuff in Carbon County. It's freezing there in the winter. If a lease ends in the winter, I'm screwed. I'm at least 3 months vacant, right? So if I'm putting someone in December, I'm trying to get their lease to end in March. So things like that, like, region, but yeah. All right. So a good property manager will send you detailed monthly reports of income and expenses. they all should do this. I mean, the systems they have nowadays are awesome. And it's very easy for them to send you this. It's all automated. Um, they keep rents at or just below market rates to encourage renewals. I am a huge fan of this. The landlords that come to me that are like, I want 1,800 for a 1,500 unit. I'm like, it's gonna sit vacant for 3 months, and you would have lost the money already. Just listed for 1,500, right? It's just math, right? So I'd rather if it's a 1,500 listed for 1,475 and get it rented quickly, then you don't have to be absurdly low. Just be lower than the market, like a little bit, and people will bite. Um, and they can get creative. Like if you have a vacancy sitting in the winter, maybe offer you know, a half off security deposit or first month's rent free. Like, especially if you're in those tougher areas, that's a big deal. And if your property manager is trying to get your property rented for you, they'll get creative. Loan considerations. So most investment property loans require 25% equity on purchase price or appraised value. Uh, there's some exceptions to that. If you have a really good portfolio with a bank, they'll lend you more. Um, a lot of fix and flip, you could find fix and flip companies that'll do 10% down on the purchase price and 100% of the reno if you have the history to back it. Um, most fix and flip lenders won't lend you on a property that the renovation costs are higher than the purchase price. So when like I have a 4 unit listed in Germantown right now, and it's listed for 250, and to make it what it should be, it needs like $1 million in work, right? Like, and every time we got an offer that was they were using hard money, I'm like, don't even bother. You're not gonna get financing. And the agent like, oh no, my client could definitely get financing. I'm like, let's tell them talk to their lender and then call me back. And then it would always be, yeah, they can't get the financing for it. Like they're not going to do it. It's too much risk for a hard money lender. Um, Up to 10 properties can be financed using conforming Fannie Mae loans, meaning in your name. Um, why you would want 10 properties in your name, I don't know. I think it's not worth the risk. Just get an LLC. But um, yeah, conforming loan, and there's ways around that too. Like if it's up to 10 properties, you can then just clump them into like a blanket mortgage and start over, right? So there are ways to still continue investing in just your name, but again, I don't know why anybody would do that. Conforming loan rentals must you conforming loan rentals must usually be owned personally. So I said not an LLC or a trust. And usually they come with terms of 6 months, principal, interest, taxes, insurance reserves, typically require for each separate rental property 70% LTV max on refinances. I've had some lenders do 75%. Personally, I don't like to take out more than 65%. I think the more equity you have, the better, because if the market crashes 20%, you're still safe, right? Okay, so we're going to talk about the BRRRR method a lot more. This is just a stock presentation. I like to go into some real life examples of how I've burned properties over the years. So while I'm doing that, you guys have any questions? Nothing? Okay. It's currently a 3 unit with a commercial space, but it's a shell, and it needs like when you're doing that in Philly, you're new construction, so you're gonna have to put a sprinkler system in. They're gonna have to like the plans. Most contractors in Philly are like $180 a square foot for renovating costs. And this property was like a 7,000 square foot building. So was that? Uh, I'll tell you. I don't have the exact address, but yeah, right by where that train goes over. Uh, I'll get you the address. Um, it is under contract actually. We did sell it to a cash buyer. But it would be a nice property if you have the cash or like the capital to do something like that. But if you're seeing a deal and thinking you could pull off a quick fix and flip, or it's just not for that. All right, so I'll start with what I think everyone should start with, which is a very simple BRRRR. So this I'll use the same McDade Boulevard property I was telling you guys about. Um, oh yeah, I guess. All right, so again, really simple example of what you're looking for when you BRRRR, right? So when you're doing a BRRRR, you essentially want to work backwards into the property. So you start off with what is it going to be worth when I'm done, right? So if it's a property you think and it's going to be worth $200,000 when you're done, or $1 million, whatever, you know, when you refinance out of it, the most you're going to get is 75% of that, right? So on a $200,000 property, that's 150,000. So if you want it to be a perfect BRRRR, all in, you can't be more than 150,000. Now, the reality is most BRRRRs aren't perfect. Most BRRRRs, you're going to leave some money into them, right? It might be $500, it might be 5,000, it might be 20,000. The whole point is to get a property without having to put 25% down and leaving it in it for 5 to 10 years before you see a return on that money, right? So as long as you're doing a BRRRR and you're getting a better return than that, you've won, right? So on a $200,000 property, you know you can't get more than 75% out of it when you're done. That's 150,000. And let's say this property has $75,000 in renovations. So you're down to the max you could pay for it is 75. But you have buying costs, you have holding costs, you have utilities along the way, you have the mortgage payment you're going to pay on it, you have closing costs, when you refinance it. So let's say that's $10,000. So now 65,000 is the most you can pay for it. That's how you evaluate a BRRRR, right? Start at the end and work your way back. So if you see a property on the market and it was listed for 120 and you use the same math, most you can offer 65, just is what it is, right? Uh, you also do the same thing with the rents, right? So you work your way back. You say, when I'm done with this, what is it going to rent for? If it's $2,000 a month, and I know I'm going to get a loan for 150, what's my principal, interest, taxes, and insurance? And what after I factor 30% for uh, capex, vacancies, and property management, am I still making money? Right? And that's for me, making money is anything more than $100 a month on that exact one unit building, right? People are like, is that worth it? That's why people freak out when they actually hear the real numbers about real estate, because they're like, oh, whoa, you're going to do 9 months of work and in the end, you're only going to make $100 a month. Yeah, because I got $50,000 in equity and I have a tax write-off, right? There's more to it than just $100 a month. And if I do 10 of those in a 3 year period, because I start to accelerate as I grow, I could then clump them and go buy what I really want to buy, right? So you have to look at big picture. Again, what's your end goal? But understand, work your way back into the numbers from where you plan on ending up to where you're going to be, right? So that's how a good BRRRR should work. A great BRRRR is you do all of this and you're only 140 into it and you get 150 out of it. That's 10K tax-free money, right? Because it's borrowed, right? So this is a very simple example of how to evaluate a BRRRR. Uh, but the thing about BRRRRs, the great thing about BRRRRs is they scale. So You can go from a simple row home to a duplex to a quad to a 10 unit to a commercial building. Any building could be bought with the same uh, idea in mind, right? The one thing, once you start scaling up to bigger buildings, you have to understand is cap rates and how banks evaluate properties, right? So I'll give you like a bigger example, one we did. Okay, so this property is an 11 unit building in a place called Clareton, Pennsylvania. It's about 20 minutes south of Pittsburgh. Not the best area in the world, right? I'm not, it is, it's a tough neighborhood. Got the property for $375,000 because it was only 50% rented at the time. Uh, there's 10 residential units and one commercial unit. And the landlord owned it for 40 years. He was charging bottom rents. The commercial unit was his storage room. Just no improvements, right? So we got it for 375. Over that time, I didn't have to put that much money into it because commercial units usually are fit out by the tenant, right? So I put it on the market. I put the commercial unit on the market for $600 a month. I got a convenience store to come in and say they'll, double net, they'll fit it out and they'll pay the majority of their expenses. So really I'm netting a lot on that because I didn't do anything. And I just had to list it. Like he was like, nobody's gonna rent here. And it filled in 30 days, right? The residential units, again, went through cleanup, light cleanup, maybe some new carpets, some new paint. One or two of them I had to do in the kitchen. I put new furnaces in the entire building. That was my biggest expense. Like there's individual furnaces for each unit, but I'm like, I don't want any of them to break. Um, and I cleaned it up a bit. Got all the units rented at current market rents, which for Section 8 is $1,029 a month. He was renting them for $450 a month, right? The building, based on a lender's cap rate, is now worth $900,000. So I was able to pull every dime plus out of that building. Now, it was a year and a half. It wasn't like I did this overnight. And sure, there's always problems you don't expect. This one particularly, like someone kept breaking in and taking dumps next to my laundry room. So like I would get that report from the property manager, and this is why we have to install cameras. There's stuff like that, right? But at the end of the day, I turned a $375,000 building with 125,000 into a $900,000 building. I didn't max pull out of this. I left 40% equity in it because I'm like, this could be a great chip going forward to buy something else. But I think it's 20 minutes south of Pittsburgh. Maybe in 10 years, this area is what became of a Point Breeze, right? Like something in that and with that in mind. If I keep buying there and I keep putting nicer buildings together, and that's something you could do. There are entities that will just turn an entire area around. Like Point Breeze was that OFC guy or whatever. He did the whole area. Like he started that. He had the money to do it, but 2010 on was him, right? You can turn an entire area around if you put enough capital into it and you do it right. You bring it up the right way. You're not trying to just be a slumlord. You're actually trying to put nice buildings in. What's that? Yeah, yeah. I mean, if you're building $700,000 townhomes and that's the only thing available, people are going to buy them. And then all of a sudden, guess what? The houses are worth $700,000. So, it's so the birthing also doesn't have, especially when you're playing with cap rates, the income doesn't have to be or the repairs don't have to be extensive. You could go into a building and just get rents to where they should be, and now it's worth more, right? So if you bought like a shopping center and all of your tenants are underpaying, and you immediately raise the rents on all the tenants, the shopping center is worth more immediately, right? Um, these are the things that you look for in good deals because there are a ton of tired landlords out there, a ton. Yes, yeah, it was a 5 year lease. What's that? I put it into the lease. It goes up. There's a percentage it goes up each year. So like, even if you do a 5 year lease, you could say they can raise, but for the tenant, I cap it. So I said like we won't go more than 10% more each year. That makes them feel comfortable. And I know I wasn't going to do that anyway. So, you know, and if you're a convenience store and you spent $30,000 to get up and running, you're probably not going to want to leave in a year or two. So, you know, and I'm talking to that guy. I'm like, hey, what if I buy a building in the next town over? Would you put a convenience store there? Like, and he's like, yeah, this is our model. And I'm like, so and they're great. They pay their rents on time. They know exactly what they're dealing with, and it's good. So yeah, the BRRRR method is awesome if you understand how to scale with it. But if you're not working with a ton of capital or experience, don't start here. Start with the row home and work your way up. You'll get there.